the limitless sky. I am the inspiration that led success soar high. I will achieve, I will fly high. I am the I in SBI.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.
Hello and welcome to Business Standards Banking Show. I am Ruchika Chitravanshi. Today in our cover story, we are talking about an issue that has generated global attention, the Adani crisis, and what it means for India's banking sector. Our Bankers View section this week features Rajiv Anand, Deputy Managing Director of Axis Bank, and the Banking for You segment today will talk about the UPI going international. At the end of the episode, we will share with you the results of the last week's poll and also tell you the poll question for this week. Stay tuned. Crisis hit Adani Group has made many in the investor fraternity jittery. Last week, without naming the conglomerate, RBI Governor Shaktikanta Das said that the strength, size, and the resilience of the Indian banking system now are much stronger and larger to be affected by a case like this. There have been assurances from the banking system that they are on safe ground as far as the exposure to the Adani Group goes. We dig deeper to understand whether the Adani crisis would affect Indian banks.
On 24th of January, a report released by US-based Hindenburg Research made some shocking claims about the Adani Group. The report alleged that the conglomerate used a web of companies in tax havens to inflate revenue and stock prices. Adani Group denied these allegations. What followed not just nearly halved Gautam Adani's net worth, but also triggered a reality check for banks, non-banking financial companies, and regulators like SEBI to understand the risks on account of exposures to Adani's energy-to-ports empire. According to a report by institutional brokerage firm CLSA, the debt to top Adani Group companies doubled to 2 trillion rupees over the past 3 to 4 years. Within this, bank funding was less than 40%, while bonds, financial institutions, and foreign banks formed a larger part of the group debt. To put that in perspective, the gross NPA of listed public and private sector banks was 6 trillion rupees as of December 2022.
In my view, the exposure to Adani Group is not material for Indian banking sector. Moreover, if you see in terms of percentage, it is hardly 1% of the total loan book of the banking system. Even in terms of the net worth, it is not very material, right? And if you will go slightly deeper, you will see the private banks have even lesser exposure, and moreover, they have exposure to those cash generating assets like ports and other stuff. And however, the PSE banks have slightly higher exposure relatively, right? So if you bifurcate that 1%, 0.3 for a private and 0.7% for the public. So it is not material in terms of the NPA. So if you assume that entire book will become the gross NPA for the banks, so it will add up say 1% of total the headline number. So that would not be even the worst case scenario will not be very material for the banks. But yes, from a sentiments perspective, the stocks have underperformed or have seen some kind of beating on this news or this when we started getting this talk in the media.
Public sector banks have said that their exposure to the Adani Group is 1%, and there is no cause for worry. Some experts believe it is not the quantum of debt, but the ability to pay that counts.
And do they have repaying capacity each year? That is the point to be seen. And are the cash flows stable? That's another point to be seen. Are there the future expectation of the cash flow is positive or not? That's to be seen. So from all those counts, there is no challenge to Indian banking system or Indian bond market that there is likelihood of any default as on date. There is no risk to banking system, domestic, global banking system, non-banking system. That is the market.
NBFC.
Even the market, because they have market borrowing by way of bond and debentures, even that is not an issue. And they have enough cash which is being generated each year. But untoward incidents, nobody can predict, and they can happen in any scenario. That's nobody can comment on that.
So, what are the risks to watch out for?
So if there's a decline in the earning potential of these companies, and a decline means significant decline, or there's any other event which leads to any cascading, then those are the events to be watched. Because even the Heidelberg report has not commented on the repaying capacity of the group. They have not said that point. That's not a point covered in the report.
On the Supreme Court's direction, SEBI and the government have to develop a framework to protect the investors. That said, troubles for the Adani Group may not be over yet.
It seems that banks would have to be watchful of cash flow and the paying capacity of the Adani Group, even though they said that the exposure is not significant. In our next segment, Rajiv Anand, Deputy Managing Director of Axis Bank, spoke to our banking editor Manojit Saha on a range of issues, including the interest rate hike, demand for capital expenditure, retail deposit rates, and more.
Hello and welcome to the Business Standard Banking Show. The Reserve Bank of India increased the repo rate by 25 basis point to 6.5% during the February review of the monetary policy. Since May 2022, the repo rate has been increased by 250 basis points. How have these actions impacted banks' performance in terms of growth and margins? To discuss some of these issues, today we have with us Rajiv Anand, the Deputy Managing Director, Axis Bank. Mr. Anand, welcome to the show.
Thank you for having me, Manojit.
Are you saying an impact on loan demand, particularly on retail side, due to the sharp increase in interest rate over the last few months?
I think what we have seen so far, Manojit, is in a sense a normalization of interest rates. Interest rates were brought down sharply during the pandemic, and what we are now seeing is a normalization of those interest rates, and now increasingly some tightening of that liquidity as well. Because if you look at rates relative to let us say 31st December 2018 to where we are today, some rates are slightly higher, some rates are the same, but one of the rates which are lower is corporate rates, and maybe we can talk about that a little later. So in that sense, we are not yet seeing any impact on growth. So much so that I think in an environment that the RBI predicts for next year, which is 6.4% growth on GDP,
Right.
with about 5.4% inflation. If those two metrics do play out, we do believe that that credit growth for next year will also continue to be quite strong, somewhere in the 15% vicinity.
So yes, the credit growth has been strong so far. But on the retail side, have you seen some impact? I'm asking this because Axis Bank's home loan growth was in single digits for the first 9-month period. What could be the reason for that?
So I think there were some sort of tactical decisions that were taken by Axis, and you will see a more normalized growth rate on the retail side. We are not seeing any sort of material impact at this stage from a demand perspective from the retail side. Last year same time, the third and the fourth quarter were quite strong, so obviously the base effect is also playing some part. But I think it's fair to say that at this stage the higher interest rates are not having any material impact on demand.
Coming to the corporate loan side now, corporate loan growth has been robust, not only for Axis Bank, for other banks also. But I wanted to know, is it mostly demand for working capital refinance, or are you seeing some private capex demand also?
I think it's a mix of all the three. We are seeing higher working capital demand. We are seeing some refinance activity. But I think more importantly, the last point that you made, I think the private capex environment is probably the best that we have seen in the last 3 years. Is it as much as we would like it to be? Probably not. But I think we can well and truly say that the new private capex cycle has well and truly begun, and barring any untoward incidents in 23-24, in an environment where the economy is expected to grow 6.5%, I think private capex should continue to be reasonably strong. In fact, will gather momentum in 23-24. In addition to that, we have also seen in the budget a significant increase in government capex as well.
Right.
I think if you put both together, it augurs very well, for India from a gross fixed asset formation perspective.
Can you tell us some of the sectors from which this private demand is coming from for capital expenditure?
So we are seeing a fair amount of activity in renewables. We are seeing activity in city gas distribution. We are seeing activity in roads. And in fact, we are now beginning to see capacity expansions in iron and steel and even FMCG. There is a medium-sized coffee company who is looking to increase capacity. So the point I'm making is it is becoming more and more widespread as we speak.
Coming to the retail deposit part now, do you see there is scope to interest rates to increase the retail deposit rates?
I think you what we saw in this cycle was that non-retail term deposit rates went up quite sharply before retail deposit rates.
Right.
But over the last 3 to 4 months, we have already seen retail deposits catch up with non-retail deposit rates. In fact, there are banks which are now offering 8% for senior citizens, which is a very attractive rate. How much more deposit rates will go, we'll have to sort of wait and watch. That will of course be based on the need and demand for money, which in turn is based on how credit will grow going forward. But ultimately, if deposit rates do go up, remember that through the MCLR mechanism, it will mean that rates for borrowers will also go up.
Now, coming to the Citibank transaction, initially it was expected that the deal will be completed by March 2023. It seems the deadline is getting pushed a bit. What could be the reason, and when do you expect the deal to be completed?
Manojit, I don't think your information is correct. We had said that we will close what we call LD1, the legal date 1. That's the date on which we pay consideration. The assets and liabilities come to us. The people come to us, customers come to us,
Right.
and the employees come to us. We are well on track to be able to meet this deadline of completing LD1 in March of 2023. What will then happen is that there's a period of 18 months of transition.
Right.
When it will take us, as far as a Citibank customer is concerned, after LD1, he will continue to be on the Citibank technology platform, and he will migrate or transition to the Axis Bank platform over a period of 18 months, which is what we call LD2. So therefore, there's an 18-month transition period. So we are well on track to meet our
LD1
dates, that LD1 date that we had broadly guided about.
Thank you. Mr. Anand, it was a pleasure talking to you as always. Thank you for speaking to Business Standard.
Thank you for having me again, Manojit. Thank you so much.
Mr. Anand has called the interest rate increase a normalization of interest rates. It was also interesting what he said about widening of capex demand from the private sector, from renewables, roads to expansion in FMCG and iron and steel sectors. Moving on, in Banking for You today, we will talk about India's UPI going global with the recent RBI announcement that it would allow inbound travelers from G20 countries to use the unified payments interface. Raghu Mohan explains what this means.
The Reserve Bank of India's decision to allow inbound travelers from G20 countries to use the Unified Payments Interface Service or UPI while in India is a huge booster. In a single fell swoop, it will increase UPI's awareness to a wider audience and may act as a marketing and branding catalyst for there is nothing that even remotely mirrors UPI anywhere in the world. The facility will be extended to travelers from G20 countries arriving at select international airports in India. Announcing the rollout last week, RBI Governor Shaktikanta Das said that UPI had become a ubiquitous payment instrument for retail electronic payments in India. An enhancement has recently been made to provide UPI access to non-resident Indians who have international mobile numbers linked to their NRE or NRO accounts. It is now proposed to permit all inbound travelers to India also to access UPI for their merchant payments while they are in the country. Apart from minor blips during the pandemic, the volume and value of UPI transactions have continued to rise over the past 2 years. The National Payments Corporation of India or NPCI has eyes set on a target of 1 billion transactions a day, from a peak of about 280 million a day. So it's less than 4 times away from daily volumes, which can be achieved over the next few years, said Dilip Aspe, Managing Director and Chief Executive Officer, in January this year. What is not clear at this point is whether UPI for India-bound travelers will also be free. It also remains to be seen just how authorities' latest move on the UPI front will affect the remittances business and local usage of credit cards by inbound travelers. According to the World Bank's Migration and Development Brief released in November last year, India is on track to receive more than $100 billion in yearly remittances. It is possible that UPI may eat a share of remittances through legacy channels, with non-resident Indians opting for this route.
I am the blue of the limitless sky. I am the inspiration that lets success soar high. I will achieve, I will fly high. I am the I in SBI.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.
As Raghu said in his report, it is not clear at this point whether UPI for India-bound travelers will also be free. I guess we have to wait and see how this rolls out. Circling back to where we started our show today, the Adani crisis. Our consulting editor, Tamal Bandhopadhyay, explains in the upcoming segment what are the challenges for the group, our infrastructure financing, and his take on what the exposure to Adani Group's debt means for banks and NBFCs. Hello, Mr. Bandhopadhyay, and welcome to the Banking Show. So let's dig into the main question that we have on our minds today. That post the revelations in the Hindenburg report, there have been a lot of assurances from the banks in India and the RBI that everything is all right as far as exposure to Adani goes. What is your take? How concerned are you about the situation?
The banking system exposure to the Adani Group is less than 80,000 crore. Now, what is the total credit market in India is more than 130 trillion. So theoretically, it's not the case at all. If the entire loan turns bad, and if there is no asset to back up, and if the entire close to 80,000 crore loan banks need to declare as NPA, what will be the hit on their balance sheet? It's about 60, 70 basis point, little more than half a percent. You look at the between SR and Bhushan Steel, the combined exposure, what the banks claimed was 1.03 trillion. The first 12 cases which gone into IBC in 2017, their combined exposure was close to 3.5 trillion. So this is not a substantial amount which can affect the bank. And mind you, this is well within the bank's exposure limit. What is the bank's exposure limit? And this is not in India. This is a Basel norm. Across the globe, this is the fact. A bank can take an exposure up to 25% to a group and 20% to an entity. I am repeating, this is the Basel norm. Till I think 2016, it was 40% to a group and 25% to an entity. And on top of that, banks were allowed to take even extra if their if they are lending for infrastructure projects. So it would have taken the group exposure to 50% and single entity exposure to 30%.
What about the exposure to the NBFCs, and are there any systemic issues there, you think?
Yeah, there are exposure to NBFCs, but again, just look at whatever the published information here say. I have gone through is this. The Adani Group's total debt is 2 trillion plus, out of which close to 80,000 is to Indian banks. And then you go to to check their exposure to overseas, which is quite a bit. I think it would be another. It would be a trillion or so in the current exchange rate. So the total NBFC exposure, I'm not qualified to say, but I don't think it is hugely significant to create a systemic risk.
That is good. So what does it all mean for the Adani Group itself? What are the challenges they will face?
Well, as you have seen that there are some certain bonds have already become junk. Their yield has risen dramatically over the last fortnight or so. So what does it mean? They will find it extremely difficult to raise money overseas. So then they will shift. They have no choice but to shift to the domestic market to raise funds. Now, will the banks welcome them with garlands? I doubt, because the banks are very different now what the banks were before the so-called AQR asset quality review, which RBI conducted in 2016-17 to clean up the system. The bank's underwriting capability, risk management, etc., is far better than what it was 7-8 years back. So banks will be circumspect, and banks will not be exactly forthcoming with garlands to give money to them. So what does this mean? That Adani Group's cost of fund will go up, they will find it difficult to raise money, and they have to curb their ambition.
One last question we have is, India wants to become a 5 trillion economy. Infrastructure is a big part of it. How does it impact our infrastructure financing, and what are our options now?
But the ideal way of doing it is, whoever is building infrastructure, let them raise the first round during the construction fine. It's a high risk, high price loan. Let them raise from the bond market, and let the banks come in the next stage when the risk is less and pick up the loan from there. That's the way internationally it is done, and that's the way it should be done if you want to de-risk banking sector and build infrastructure. Of course, we need to deepen the bond market. The government, the regulators, everybody has been trying, but it's not as deep as it should be. So that work is still unfinished.
Great. So challenges remain for Adani Group. It is good to hear that banks are on safe ground still. And as you said about the infrastructure financing, we need to deepen our bond market. Thank you so much, Mr. Bandyopadhyay, for joining us and sharing your thoughts today.
Thank you.
Tamal's views on bank exposure are quite in line with what our banking experts said in our cover story. While he is not concerned about bank exposure, money is going to get costlier for Adani Group. And as he said, the conglomerate might have to curb its ambition. This brings us to the last and final leg of our show, the BS poll. We asked you last week, will the Adani crisis affect Indian banks? 51.12% of our respondents said yes, while 48.88% said it would not. This week, we would like to know that with CPI inflation crossing 6% in January, should the RBI's MPC raise the repo rate further? Our poll opens on Friday, and you can respond on Twitter, Instagram, LinkedIn, Telegram, and our website. We will be back next week with more news and analysis. Thank you for watching.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.
I am the blue of the limitless sky. I am the inspiration that lets success soar high.
the nation's trusted bank, SBI, the banker to every Indian.